Welcome to our deep dive, where we dissect and analyze the latest trends into India's IT sector's performance, examining the key indicators and shifts shaping the industry. We're focusing on the first quarter results for FY26, providing a comprehensive overview. This period, ending June 30th, 2025, offers critical insights into the current state of affairs. It reveals a split in the industry, a tale of two halves, if you will. We're seeing caution among the giants, the established players in the IT landscape. But there's also opportunity for nimble mid-caps, those agile companies ready to seize new prospects. Global economic uncertainty is a significant factor, casting a shadow over investment decisions. This is especially true in North America and Europe, key markets for Indian IT firms. The uncertainty is making clients hesitant, leading to a more conservative approach. They're hesitant to spend on new tech projects, carefully evaluating each investment. Consequently, large IT firms are seeing slower revenue growth, a trend that demands attention. They are therefore doubling down on cost efficiency, streamlining operations to maintain profitability. This is all being done to protect margins, which are under increasing pressure. Meanwhile, mid-cap companies are finding ways to thrive in this environment. They are leveraging their agility and specialization, offering niche services that are in high demand. This allows them to win new deals, securing contracts that larger firms might miss. This is especially true in generative AI, a rapidly growing field, and also in the BFSI sector, where specialized solutions are highly valued. The market is shifting, a fundamental change in how IT services are consumed. Clients now value targeted expertise, seeking out companies with specific skills. They value this over sheer scale, prioritizing quality and relevance. We'll first examine the performance of the industry giants. We'll start with TCS and Infosys, two of the biggest names in Indian IT. Then we'll move on to HCL Tech and LTIMindtree, analyzing their recent results. After that, we'll focus on the standout mid-caps, the companies that are exceeding expectations. We'll be looking at Mphasis, Coforge, and Persistent Systems in detail. We'll wrap up with sector-wide themes, identifying the key trends affecting the entire industry. This includes margin pressures, which are a concern for many companies, and also currency impacts, which can significantly affect profitability. Finally, we'll look ahead to the future. We'll see what the rest of FY26 might hold, considering the challenges and opportunities ahead. We'll provide our outlook for India's IT sector, offering insights into its prospects. So let's get started with the industry leaders and delve into their Q1 FY26 performance. TCS adopted a cautious tone this quarter, signaling a shift in their strategic outlook amidst evolving market conditions. The company reported modest revenue growth, a reflection of the current economic climate and its impact on client spending. They also noted slower deal conversions, particularly in the crucial North American market, indicating a hesitancy among clients to commit to new projects. The overarching focus is now firmly on stability. Nurturing long-term client relationships and enhancing operational efficiency have become the top priorities for TCS. Infosys echoed this sentiment, painting a similar picture of the challenges and opportunities they face. The company reported subdued growth, further compounded by ongoing margin pressures resulting from recent wage hikes implemented to retain talent. However, the successful acquisition of several large deals offered a beacon of optimism, suggesting potential for future growth. Both companies are undeniably feeling the impact of broader economic trends. A significant factor is the noticeable slowdown in the banking, financial services, and insurance (BFSI) sector. Financial clients are increasingly prioritizing cost optimization initiatives over embarking on large-scale digital transformation projects, impacting revenue streams. Both TCS and Infosys are actively attempting to offset the BFSI slowdown by strategically targeting other sectors, such as manufacturing and life sciences. Despite these efforts, the challenges within the BFSI sector continue to exert a considerable drag on overall performance. Favorable currency fluctuations provided a marginal degree of relief, offering a slight buffer against economic pressures. However, these gains were partially offset by cross-currency headwinds, adding another layer of complexity to financial management. For both TCS and Infosys, The current period is characterized by consolidation and strategic realignment. Their primary focus is on protecting existing profitability margins and diligently preparing for an anticipated future rebound in market demand. The emphasis is on a conservative growth strategy, prioritizing stability and sustainable practices over aggressively pursuing rapid expansion. HCL Tech delivered steady results, maintaining margins through strong cost control and a focus on infrastructure and engineering services. Its services business held up, and European deal wins helped offset US softness. LTIMindtree, meanwhile, outpaced larger peers with robust revenue growth, thanks to deep BFSI expertise and early leadership in generative AI. By delivering real AI-driven business outcomes like fraud detection and automation, LTIMindtree is winning innovation budgets even as clients scrutinize spending. This quarter, LTIMindtree proved that specialized expertise and a focus on emerging tech can help mid-caps challenge the giants. The mid-cap momentum continued its impressive run, showcasing the resilience and potential within this segment of the Indian IT sector. Mphasis, Coforge, and Persistent Systems, all posting strong results, demonstrating their ability to navigate the evolving market landscape. Mphasis leveraged its established banking relationships and its comprehensive end-to-end digital transformation capabilities, which fueled steady and sustainable growth. Coforge excelled particularly in the travel and hospitality sectors, winning significant large-scale contracts as those sectors experience a robust recovery. Persistent Systems stood out in the market for its distinct engineering focus, building highly complex and innovative software products, and successfully maintaining strong, sticky client relationships, fostering long-term partnerships. The common thread: specialization and agility. These firms are winning in today's competitive landscape by offering deep expertise and quickly pivoting to capitalize on new opportunities, such as the rise of generative AI. Their consistent outperformance signals a significant shift. Clients increasingly prefer engaging with specialized partners who possess niche skills, rather than relying solely on generalist giants. Margin pressure was a defining theme this quarter, with wage inflation and client pricing demands squeezing profitability. Revenue growth slowed as clients delayed big projects and focused on cost optimization. The demand is shifting from large multi-year deals to smaller outcome-driven projects. Currency movements added volatility. Rupee weakness helped, but cross-currency swings complicated forecasts. The big story: large caps are struggling to grow at scale, while mid-caps thrive by focusing on niche areas and high-growth tech. This could signal a long-term industry shift toward multi-vendor strategies, with clients mixing large partners and specialized mid-caps. Looking ahead, cautious optimism prevails. Mid-caps like LTIMindtree, Coforge, and Persistent are expected to keep outperforming thanks to their focus on AI, cloud, and analytics. Tier 1 giants are investing in generative AI and operational efficiency, but their growth depends on a recovery in BFSI and high-tech. The biggest question: when will client spending rebound, especially for discretionary projects? The sector's recovery hinges on global economic improvement and renewed client confidence. For now, mid-caps are winning the race, but all eyes are on the next quarter for signs of a turnaround.